And here is a statistics of numbers of firms in the United States in millions. As you can see, sole proprietorships and partnerships are pretty large, and also corporations is pretty large. So in percentage, the sole proprietorship is basically taking the majority of it, but the size of a business for corporations is much bigger. So the total revenue they have is 50 trillion dollars, whereas the other forms of business are pretty small. So in other words, there are not a lot of corporations in terms of total numbers, but the cash flows involved with corporations, as well as the employment, revenue, total assets, is taking the majority in this country. All right, so for the rest of the class, we will focus on corporation and the financial management of a corporate. So basically, that's corporate finance. So if we look at a corporation organization, that's the structure of it. So on the top of it, of course, it is owned by a lot of stockholders. So if you buy a share of Apple, then you are a stockholder of Apple, and you are an owner of Apple. You are just one of the millions of owners who happen to have the shares of Apple. So the stockholders are the joint owners of the firm, and they will join together and elect a board of directors through a democratic method. And then the board of directors will be in charge of a firm's major decisions. The board of directors, however, still cannot just meet every day and run the firm every day. They have to hire a president or a CEO to run the firm on a daily basis. So CEO is the top manager of the firm. And under the CEO, there are different vice president in charge of different aspects of the firm. You have the COO, you have the CFO, and the COO or chief operating officer who be in charge of human resources, manufacturing, marketing, and you also have a CIO who is in charge of information technology. So for this class, we're going to focus on this tree of organization. So under the CEO, we have a CFO whose position is parallel with other vice presidents. So the CFO is a chief financial officer. Under this position, there is a controller, there is a treasurer. And the controller is basically in charge of the information, and the controller does not touch money. And the treasurer basically is in charge of money, and not just the cash, but also credit. As you can see, under the treasurer, there is a capital expenditure manager. If a firm wants to buy another small company or buy a big factory or making major spending of their money, that's called a capital expenditure. So that's very important for the firm's plans. And you also have a cash manager, a credit manager, which is the managing in the short run. And you also have financial planning and the raising managers. You also have fund managers who are in charge of the investment of the firm's cash in the short run. If the firm is a global multinational corporation, there is a position called a foreign exchange manager. The controller is in charge of the collection, consolidation, and dissemination of information. So there will be a tax manager, cost accounting manager, and a general corporate accounting manager, and a financial accounting manager. The accountants here, or the accounting managers, are in charge of the transactions and journal entries and the great ledger. They do not just they do not touch the money, but they have to do the bookkeeping of how money is spent. It is very important that the role of a treasury and a controller have to be separated, because you don't want the people who handle cash also make the report, and that would be a very dangerous for a company. If a person holding the cash also making the report, then that's corruption. There could be a big room for corruption. The person could just spend $100 on itself and then report to the company that $100 is spent on the company's behalf. And here, let's talk about the goal of a firm. If you graduate and take a job in a corporation, and someday you will move to a very high position of the company. You will need to swear a solemn duty that everything you do is to maximize the firm's shareholders' wealth. So that's basically the goal for a firm to exist, to maximize shareholders' wealth, to make money for the shareholder. And right here we have this figure. There are financial managers, so they try to make financial decisions for the firm. And when they make decisions, they always consider return and risk, right? Is the return high enough or is the risk low enough? And then they will ask themselves, will this increase the share price or the stock price for public companies? Of course, the stock price is representing the shareholders' wealth in the long run. So if it does not increase the shareholders' price, they should say no and reject the project. If the price would increase, they would say yes and accept the project. So for a company, for a public company, where who has stocks available in the stock market to trade, then the manager's goal is to maximize the stockholders, to maximize stock values in the long run. And then you have to pay attention, it is in the long run, because in the short run there could be manipulations. The managers can just fabricate fake news and push the stock up in the short run. What really represents shareholders' wealth is the stock price in the long run, which are determined by the fundamental economic factors, whether the firm has solid, good products and making enough revenue and profit or not. There are also different stakeholders for a firm. We have employees, customers, suppliers, creditors, owners, and also many other parties in the society. The goal of maximizing shareholders' wealth is criticized in other countries. That goal of maximizing shareholders' wealth is the goal in Anglo-Saxon countries like United States, like United Kingdom, South Africa, Canada, and New Zealand, Australia, with the English-speaking countries or with a common law system. And for other countries like Germany and France, their goal of companies is not just to maximize shareholders' wealth, but to maximize stakeholders' wealth. The stakeholders, again, include employees, customers, suppliers, and so on. So they treat the entire society as an ecosystem. So the firm cannot just do for the shareholders. That's too selfish. If you look at a Chinese company called Alibaba, who has the largest initial public offering in the United States stock market, the CEO of Alibaba, Jack Ma, basically says the goal of his company is to maximize the wealth of customers, and then employees, and last, shareholders. You can see different countries have different ideas of company goals. And in Japan, a corporate goal would be maximize the wealth or the well-being of the entire corporate family, like Mitsubishi. Mitsubishi has companies or businesses in banking industry, in car industry, in construction tool industry, so in many industries. So one company in one industry has to think about the entire Mitsubishi group in different industries. So not just for this small individual company. So that's a different ideology in different countries. All right, now let's get back to our common law system employed by United States and United Kingdom and all these Anglo-Saxon countries. So if the goal of the managers is to maximize shareholders' wealth, the thing is managers are not shareholders in many cases. So the managers may be selfish. They may just use the company's money for their own interest. So here it comes to this important topic called agency problem. So the managers are naturally inclined to act in their own best interest and not necessarily the same interest as the shareholders. So basically, it says the managers are selfish. They may use the company's money to buy expensive perks or luxury office supplies or a corporate jet for themselves, and that will be wasting money in the eyes of shareholders. Okay, and also the managers would fight for their survival, wasting the company's resources to window dress their performance during their contract, so they could get another contract. And this is my favorite. The managers like to build their empires by acquiring small firms or opening new businesses that may not necessarily generate a positive profit for the firm. This is called empire building because the managers treat themselves like a king of the castle, and they always want to conquer more land and having more employees under control, although these activities may be wasting company's money. And some managers also want to fight for independence. They don't want the owners to pinpoint what they do, so they could waste the company's resources just to be independent. So, in terms of solving agency problems, the owners have to design certain strategies. One popular strategy is to design managerial compensation packages. So these packages basically is a payment structure. Not only the managers will receive a salary and bonuses, but they will also receive company stocks, company options. An option is a financial security whose value would go up when the stock price go up. In other words, if the company's stock is going up, the managers get paid better. So this way, the managers are made are made into a owner, or their interest is aligned with the owners of the company. So therefore, the managers would work more and better toward the interests of shareholders. And also, the owners could directly intervene the management team. So just just let you know, the shareholders have a final say of everything, and the managers cannot just beat shareholders in terms of conflict. And also, the shareholders can monitor the managers. They can hire a proxy, or they can hire a third party auditing company to check whether the managers are doing the right job. And then we have this agency cost. So the agency cost could be direct and indirect. A direct agency cost would be the money wasted by the managers, okay, or agents. So the agents are hired by the owners. So these are managers. And the indirect agency cost would be money spent to control agency problems. So you can see the difference. If the managers are selfish and wasting money, that's direct cost. If the shareholders are doing all these strategies, like paying them stocks or hire people to check the managers or monitor the managers, that's also costly. So this is an indirect cost of agency problems. And in the discipline of finance, corporate governance is always a very important topic. And corporate governance refers to the rules and process and laws by which companies are operated, controlled, and regulated. So it's about fighting for the best balance between managers and the owners, and try to align their interest and make sure the managers are behaving at the best interest of shareholders. So in the good corporate governance structure, the rights and the responsibilities of corporate participants should be well defined. So these participants would include shareholders, board of directors, the major top managers, and stakeholders, and so on. And you could be individual investors, or you could be institutional investors as an owner. Well, as I mentioned earlier, as long as you have a share of company's stock, you are a owner. No matter how many owners there are, you are still an owner. And if you invest in company stocks, you become an owner. And you could be an individual investor when you have a small quantity of shares. You could be an institutional investor if you work for a bank or insurance company or any finance institutions with a lot of money who happen to buy the company's shares as investment. So unlike individual investors, the institutional investors have a more power in terms of influence the company's managerial team. They could intervene directly or threat the board or, and share their concerns and of course communicate more effectively compared to individual investors. So the summary here is in the world of a corporate, there's always a principal agent relationship. So principal is the owner, agents are the managers. So we have to make sure they are doing the right work and their interest would be best presented.